The top business stories live from the Sky News City studio. Sunny weather gives retail sales a boost, beating expectations but still down on last year's figures. Why companies are overestimating their ability to use AI to handle customer engagement. And the tech investors who hope the next big thing will be in Africa. Good morning, this is Business Live with me, Ian King. We begin today with a boost in retail sales, helped along by record temperatures last month. Retail sales volumes rose by 0.7% month on month, with the Office for National Statistics reporting increases in food, non-food and online retail. The biggest increase was in non-food sales volumes, which rose by 1% in June, following a fall of 0.5% in May, with summer sales boosting department stores and furniture retailers in particular. But food store sales volumes bounced back with 0.7% growth in June, following a fall of 0.4% in May, when the extra bank holiday for the King's coronation boosted eating out and takeaways at the expense of the supermarkets. Now, UK companies are overestimating their ability to use AI to handle customer engagement. That's a warning today from the Institute of Customer Service, the independent body that helps companies and public sector bodies raise service standards. It says this is resulting in longer call wait times and growing dissatisfaction from customers, just at a time when more people are likely to be calling companies with complaints. Well, joining me now is David Dagger from the Institute of Customer Service. David, morning to you. Why is this happening?
Good morning, Ian. Well, I think there's probably a number of factors at play, but I think one of the issues that organisations are having with AI is how that it fits into everything else that's going on. How do they combine it with the data that they've got and with well-trained customer service agents who can help with the more complex queries? And AI, when it's deployed well, I think can help to cover off those transactional pieces and the simple inquiries really well, and the tech that comes around that. But for the more sensitive inquiries, for the more complex ones, you need to be able to get through to the well-trained staff that can actually help you to address those in a quick, efficient way. And I think where people get stuck in loops with chatbots, we're seeing they're getting very, very frustrated about that.
And this, according to you, this is already impacting customer service standards.
Absolutely. And so our UK Customer Satisfaction Index is the barometer of customer satisfaction in the UK. And what we're seeing is we've just now seen the biggest annual drop since we started doing this index back in 2008. It's at its lowest point now since 2015. And there's drops across all sectors. I mean, most noticeably things like transport and utilities that you might expect, but every single sector of the UK economy has dropped.
And in terms of activity levels right now, you think this is just at the peak sort of time when people are going to be making more calls to companies?
Yes, I think what we're seeing, the cost to businesses of not getting things right first time is £9.8 billion a month. And although actually the amount of issues that are being highlighted by customers has stayed pretty static, the amount of time it's taking to resolve those issues has gone up, and the satisfaction with how those are being resolved has actually declined. So there is something not quite right. And if organisations are investing more in technology to try and presumably get much better at this, not just more efficient, there's something not quite clicking at the moment.
Does this mean that companies shouldn't engage on automation using AI?
I think that most companies who want to deliver an effective and efficient customer experience will need to invest in technology and AI, but it can't just become another layer between the customer and the ultimate solution. Where it can really help to facilitate it, to help me to self-serve when I want to do that, but to get me to that answer as quickly as possible, it will work well. And I think the investment in the tech needs to be combined with an investment in probably better training and how everything all integrates together. You need the data at the fingertips of the people that you are talking to, and you need them empowered to be able to serve customers in the way that customers want to be served.
OK, David, got to leave it there. Appreciate you joining me today. Thank you.
Thank you.
Now, small businesses in the UK lag their counterparts on productivity in all other G7 countries, apart from Japan. That's according to research by Be the Business, the government-backed charity that seeks to inspire greater SME productivity. Well, UK firms consider their operations to be just as efficient as competitors, but are the least likely to have introduced any new initiatives to measure and improve efficiency and productivity. With me now is Anthony Impey. He's Chief Executive of Be the Business. Anthony, welcome to you. I mean, reading what you've said, it sounds like you think small businesses are being a bit overconfident, maybe.
I mean, certainly the data shows that there's a high level of confidence amongst small business leaders, and that's a really good foundation for us to start with in the UK. But unfortunately, what we're seeing is that their performance and capability is just lagging behind that of their international peers. And that's what we're calling for companies to address. We have calculated that if small businesses can improve their productivity by just 1%, will impact the UK economy by £94 billion, which is about half the size of the budget for the NHS every year. But it also crucially adds £65,000 to the profit of each and every business in the UK.
Is this overconfidence breeding complacency then?
Not at all. I mean, I travel the country meeting small businesses as part of my job. And the small business leaders that I meet are some of the most impressive business leaders in the country. Their dedication to their companies and to their local communities is huge. It's just about turning that confidence into action that I think that we need to achieve.
What I was quite struck by reading your research is that companies clearly believe in the importance of digitisation and implementation investment in technology. They're just not doing it.
Yeah, you're absolutely right. I mean, when we think about productivity, we think about it in three measures. It's the performance of the business, it's the capabilities in that business, and it's the confidence. So having a good confidence, that's a good foundation. But we've got to turn that into action. We've got to turn this very positive mindset into businesses doing things. And we see that really manifesting itself in three ways. We believe that businesses need to measure what they do and benchmark themselves against their competitors. They need to just take some time out to improve their management skills, their business skills. We think that's very, very important. And the other thing that we see is those businesses that take time away from their business and seek advice from an external mentor or an advisor have a big impact to their business. Running a small business can be a really lonely job. And so just having that external advice can give you real sort of fresh perspective on those opportunities and challenges.
Sure. So I mean, how do we learn in this country from our peers in the G7?
Well, I mean, our research shows and really highlights some of the things that countries, that our peers in the G7 do. And so I think there's a lot of things that we can do, a lot of ideas that we can pinch in order to drive productivity. And that's going to be very important. We've got this massive opportunity in the UK to unleash all this potential and really have an impact on the local communities that small businesses operate in. It's important to remember that small businesses operate in every part of the country. So if we want to have a big impact to the economy and really drive standards of living across the country, it's driving the performance of those small businesses that are going to be so important.
OK, Anthony, got to leave it there. Appreciate you joining me today.
Thank you.
Some other business news stories for you now. And the UK borrowed less last month than expected, it emerged this morning. The Office for National Statistics said UK borrowing came in at £18.5 billion in June. That was significantly lower than the £22 billion that the market had been expecting and was down from £18.1 billion in June last year. It was, however, still the third highest June borrowing since monthly records began in 1993. It means that during the first 3 months of the year, UK borrowing came in at £54.4 billion. That was up £12.2 billion on the same period last year, but some £7.5 billion less than the Office for Budget Responsibility had forecast. Interest payments on the national debt during the month came in at £12.5 billion, which was the third highest in any single month on record. The online cosmetics and beauty retailer THG has sold its loss-making on-demand division to its management for an undisclosed sum. The sale, first reported last night by Sky's Mark Kleinman, includes Savvy, once one of Britain's best-known entertainment retailers, and I Want One of Those, the gifting website. The division also includes Pop in a Box, which sells fast-moving consumer goods. THG also announced it has sold Pro Bike Kit, a specialist provider of cycling equipment, to Mike Ashley's Frasers Group for £4 million. The British asset manager Lion Trust insisted this morning it would not be raising its offer for Swiss fund manager GAM Holding. Iron Trust, whose funds are held by tens of thousands of UK retail investors, agreed to buy GAM in May for £96 million in a deal that it said would create a wealth manager with £53 billion worth of assets under management. Well, since then, a group of GAM's shareholders who own just under 10% of the company have campaigned against the deal and urged other investors to vote it down. And shares of Infosys fell by as much as 10% today after the Indian outsourcing services, consulting and information technology giant warned that sales would grow this year at less than half as quickly as it had previously estimated. The company, which was founded by the Prime Minister Rishi Sunak's father-in-law, Narayana Murthy, blamed delays to clients signing new contracts and clients delaying the start of new contracts already signed. It said sales growth this year would now be between 1 and 3.5%, down from the 4 to 7% growth previously expected. Well, Mr Sunak's wife, Akshata Murthy, owns just under 1% of the company. Well, the oil price has been trading back above $80 per barrel as the drop in US inventories earlier this week continues to raise concerns about tightness in supply. A barrel of Brent crude is currently changing hands at $80.64 a barrel. That is up 1.25% on the session. On the equity market, stocks in the Asia-Pacific region had a largely downbeat session overnight. Chip-related stocks continuing to come under pressure following the comments out of Taiwan yesterday. Only Hong Kong and South Korea finished higher in the region. In Europe, here's the picture currently. Bit of a mixed picture. Actually, the DAX in Germany, only the real laggard there. Talking points in continental Europe this morning include Danske Bank. Denmark's biggest lender is ahead by more than 2% in Copenhagen as it promised to resume paying dividends on strong quarterly results. Well, here in London, the FTSE is sort of tiptoeing into the weekend. They're more or less unchanged right now. Mining heavyweights weighing on the index. It's still on course, though, the FTSE, for its best weekly gain in 4 months. Hargreaves Lansdown is among leading blue chips for a second day running. That's after yesterday's upbeat trading statement. The shares are 1.5% to the good there. Outside the FTSE, it's also a story from yesterday that's creating waves. The defence contractor Babcock, again leading gainer. It had results out yesterday. The share's nearly 3.5% higher right now. You can see an interview with the chief executive in our afternoon programme at 4:30. On the foreign exchange markets, meanwhile, well, the pound's obviously sold off this week on the back of the benign inflation data on Wednesday. It's stemmed the bleeding a little bit there. Sterling off just over 1/8% or so against the US dollar. It's 1/10% lower against the euro. Single currency, meanwhile, more or less unchanged against the dollar. Joining me now is Bill Dinning, Chief Investment Officer at Waverton Investment Management. Bill, good to see you as ever. I mean, the inflation number this week has really changed everything, hasn't it? I mean, it sent the pound lower. The FTSE's on course for its best gain in 4 months.
Yeah, absolutely. You know, finally some good news. And I guess the real worry had been that the UK's inflation number had been just persistently higher. There'd been a real spread between what was happening in the euro area and what was happening in the US. That spread's still there, so we shouldn't get too excited. But at the same time, the direction of travel looks a lot more encouraging. And I think that's definitely shown up in terms of how the market's pricing what the Bank of England is going to be doing in the future. It was always, I think, very risky to think that the bank could get the base rate. At one point, the market was thinking it could get from 5 to 6.5. I mean, that would have done a huge amount of damage. So let's hope that doesn't happen.
But I mean, equities, first and foremost, are essentially being priced on future cash flows, the sort of cash that will be generated in future. Are people getting a bit carried away?
Well, the FTSE's lagging still terribly. You know, I mean, the Nasdaq's up probably 35% this year. The S&P's up close to 20. Europe's up 15% or something, and the FTSE's really been a big laggard. So I think the UK's got. There's been a lot of bad news that's been priced into UK assets. The one that's actually held up quite well has been sterling, but the gilt market has had another torrid time in the first 6 months of the year. And the stock market, as I said, has been lagging terribly. So there's quite a lot of bad news. And if you look at the sort of innards of the market, if you look at a lot of the companies or the things like the REITs, things that are that have been really hit by those interest rate rises, there's been some real damage done. So I think the UK, I think there's signs of hope for the UK, if you like, and I think there's certainly a value argument for a lot of UK assets.
Yeah, you mentioned the REITs, the commercial property sector, of course. I mean, a lot of these, there are notable exceptions like Great Portland Estates, but a lot of these companies are carrying quite a lot of debt.
They are, and I think if we wanted to be concerned about what what might happen in a downturn, I think it's true on both sides of the Atlantic that clearly the debt associated with commercial real estate is going to be a challenge to those companies. It's also a challenge to the banks. I think it was very interesting this week. You had quite good news from a lot of the regional banks in the US because the market's focused on the fact that their deposits have held steady. Only 3 or 4 months ago, we were really worried about that. But, those are also the banks that have huge exposure in the States to the commercial real estate market. And I think that, if we do get the downturn that many people have been expecting to happen, I think you're right. The commercial real estate market is a position of vulnerability. But again, the REITs and other ways that you can access commercial real estate through listed vehicles here, there's a lot of bad news already in there. So the market's expecting bad news, which may mean that perhaps we're some way through that.
You mentioned the United States there, Bill. Obviously, it's still relatively early days with earnings season. The banks, by and large, have performed to the upside. The likes of Tesla and Netflix have disappointed. Yeah,
and that obviously had a big impact yesterday, and will probably be some follow-through today. I think it's interesting that the headline numbers for earnings so far definitely have been a little bit better than expected. And one of the things that people watch, obviously, is how analysts are responding. And the net increase in earnings expectations is positive. And that is one of the reasons that the market's held up so well. I think a lot of us were expecting some weakness in earnings to be showing up more broadly now, but it hasn't because the domestic economy has held up reasonably well. And for a lot of the big global giant tech companies, the AI news flow in the last 3 or 4 months has given them another leg. But all of these companies ultimately are quite cyclical. And I think, Tesla is ultimately, it is a car company. and I think, if we do get that downturn, then there could be a bit more of that to come. Yeah, and more broadly, Bill, obviously the tech sector has also had a cloud over the last 48 hours by some of these comments from the chip makers, particularly in Taiwan. Is that just cyclical, or is there more to it than that in your view? I suspect that's probably cyclical because I think with the excitement level of anything associated with chips was one of the things that really benefited from the AI bandwagon. And I do think some elements of that have gotten ahead of itself. You had an earlier story about the use of AI being potentially not quite as universally, it's not going to happen everywhere. But I definitely think that the outlook, in my opinion, the outlook is still that we're going to see a slowdown in the global economy led by the US. And that does mean that there's some risk, I think, to the earnings outlook later in the year. All right, Bill. Always good to see you. Thanks for joining me today. Still to come here on Business Live, all eyes on Africa. How tech investors are hoping the next big thing will come out of the continent. Stay with us.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.
It's turning everybody into, a crazy, violent drug addict.
How are you feeling?
I am angry. Legal abortion. It is an anti-woman agenda.
2 women say that you paid for their abortions. Are you a hypocrite, sir? Will your candidates win?
I hope so. I think they will. I think they're great candidates.
I gotta be realistic. My sister's dead.
More than 4 weeks on, there's no murder weapon and no suspect. Are you going to catch this killer?
We are doing everything we can.
Ghislaine Maxwell has pleaded not guilty to all 6 charges against her. Mum, how are you feeling today?
Jeffrey said, you answer to Ghislaine, you just don't cross her.
They're so excited.
Severe nightmares of these people coming in and just taking me in the middle of the night.
I've watched as whole towns were torn apart by natural disaster.
I'm alive and I'm thankful for that, but there are a lot of people who aren't.
It's not the winds people fear most here, it's the water. We take you to the heart of the stories which shape our world.
Do you truly believe what you're saying?
A lot of cases that I know are reported from Ukrainian missiles themselves.
Ambassador, with respect, I think that's preposterous.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Welcome back. Now, more than half the world's population growth between now and 2050 will come from just 8 countries, and 5 of those are in Africa. Well, that's attracting interest from investors, hoping some of the next big tech companies will emerge from the continent. They include Norrsken 22, which has backed a number of impact-focused startups, including its latest investment, the South African challenger bank, Time Bank. Well, joining me now is Lexi Novitske, General Partner at the African Tech Growth Fund, Norrsken 22. Lexi, good to see you this morning. What do you typically seek in an investment?
Yeah, so we're seeing some incredible opportunities across the entire continent, and that's really why we built out Norrsken 22 to really capture on some of these growth stage opportunities. What we're really seeing is, look, most of the continent of Africa is young, majority of 60% under the age of 25. They're adopting these technical skills very rapidly. Talent is becoming absolutely relevant, even across the global market. But these users are essentially born with a smartphone in their hand, and they're adopting consumer tools. Businesses are being able to leapfrog the lack of infrastructure and provide education, healthcare, supply chain management using these technical skills that are really developing locally, and using these tech platforms to really unlock scale. And we're talking about scale not in just one country, but being able to really jump from one market to another, building a business in Nigeria, moving it to Kenya, and from there really even unlocking the rest of the emerging markets.
What are the challenges facing these sort of businesses, though?
Look, there are a lot of challenges in Africa because it is still a very nascent ecosystem. I mean, one of those challenges is actually the lack of investment going into the venture capital. Although we've seen venture capital growth double every year for the past 5 years and then 10x over that period of time, it's still 1% of the total venture capital in the world that's flowing into Africa. So lack of funding is certainly one aspect of that. Because it's such an early ecosystem, the availability of debt and the availability of data and what that means for unlocking opportunities across AI is also a big barrier. But even more so, a lot of these inherent challenges in Africa, the continent is fragmented with a bunch of different, not only countries, but languages and cultures. Supply chain systems aren't built out. Infrastructure is often lacking. These are all big problems in the ecosystems, but they're also massive opportunities for tech companies building solutions to meet them.
I've seen it also suggested that Africa does seem quite vulnerable to brain drains of talent. How do you stop that from happening?
Yeah, so Africa has the highest entrepreneurship rate in the world. I mean, 20% of businesses are being started by, or the youth is driving 20% of business growth across the continent, and they're building their own businesses. They'd rather build their own thing than work for an employer. But what is lacking is really those tech opportunities. So they want the skills from the Microsofts, the Googles, and so they're moving abroad to try to capture some of these opportunities. So what we really need to encourage is a lot of these global companies to come into Africa, be able to facilitate a lot of this tech skills like Google is doing with they've launched an AI research center in Ghana that's upskilled a lot of the African talent. And that inherently trickles down into the local economy. So it's giving local Africans with incredible tech skills, not only employment, but the skills that they can utilize to build their own businesses. And this is really where the opportunity is. Of course, governments need to unlock conducive environments for that and regulation to help support tech companies across the region. But we're seeing more and more of that. It's really becoming a big game changer for a lot of these markets as local governments realize that natural resources are not where the value is. It's really building entrepreneurship and this employment that comes from it.
Lexi, we don't have an awful lot of time left, but you're obviously speaking to us from Lagos. Is Nigeria really the sort of key priority for your fund, or are there other countries that you're equally excited about?
Yeah, well, Nigeria is a massive market. It's growing very, very fast, as you know. But what we see is that the businesses that are being launched here or any other region in Africa, they're not a one country solution. So they might be building their business in Nigeria, but expanding to South Africa, expanding to Kenya, and really opening up these other markets and bringing all of these fragmented ecosystems together. That's where the big opportunity is.
All right, well, it's great to talk to you this morning. Thanks very much indeed for joining me. Hopefully we'll hear more from you in the future. Appreciate it.
Thank you so much.
That's it from me. I'll be back this afternoon at 4:30 for our afternoon edition. Remember, the FTSE going into the weekend on the back of its best gains in 4 months. We'll be hearing from the Babcock Chief Executive. In the meantime, do stay tuned. Coming up next, all the latest reaction to the 3 by-election results overnight. See you later.